In this week's update, the big opportunity for 2026. Fund flows out of equities and into precious metals. Stay invested, but move up the quality scale. And this is why. My name is Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Well, it was a real bounce back week, and I can only be left thinking, wow, that was really, really quick and turned out to be relatively painless in the end. So it would appear that of the two choices that I discussed last week, that this is just a healthy spot of rotation. And that's pretty much it, because the bounce back last week in America was really strong and even managed to get a bid in Australia as well. So whilst anything can happen from here, the probability is that this little correction has run its course, which is quite surprising given where we stood last Sunday. There is a continued mix of signals, I have to admit, but it's heavily weighted towards the gentler kind of valuation reset that I talked about last week, rather than a significant top that's going to be lasting several months. So for mine, the bull market remains intact. Stay invested, but definitely move up the quality scale. And as I said last week, this is not a time to be in low quality stocks. And if you've got some stocks that have become heavy weighting and have got lots of froth built into them, then it might be not a bad idea to think about taking a little bit off the table. So I think that's where we stand. Now, the reality is, when you look at the fundamentals, this is the outcome that we should get based on the fundamentals, because we've got good, strong US earnings growth. The revisions, most importantly, more than the earnings growth, it's the forward revisions, are sound. AI demand is real. There's no question about this. All this bubble chat is just really a distraction. And most valuations are not ridiculous. There are a few that are over the top. But in general, most of the valuations are being well and truly supported by the earnings growth. So last week I talked about two choices. One was a significant top. The other one, the most likely outcome, was that we didn't get too much of a correction, but not in my wildest dreams did I think it'd all be done in 1 week. I thought that the high multiples would get progressively offset by a balance between strong earnings growth and a bit of a PE reduction because the prices came down, and that certainly looks how it's playing out now. Now, this is just normal bull market behavior. This is what happens in normal bull markets. But I guess it's the savageness of these reversals, even though they might only last a week or two. And it's being amplified by just the excessive leverage that's in the system now and the margin calls. I think it's far greater than it was, let's say, 10 or 20 years ago. So it's just amplifying everything and making it feel like it's a more significant event, when it's not really. It's just a normal bit of readjustment in an ongoing bull market. Now, in the opening slide, I mentioned that the big opportunity for 2026, and in some respects, there's no really earth-shattering new information here, but just to really bring it into focus, it would appear that precious metals, copper, critical metals, including things like lithium and antimony, are set for a really great period. But for me, the real opportunity is in the developers. It's not so much in the producers, because a lot of the producers have been fairly fully priced. But the opportunity here is really with the standout stocks, the developers that stand out in a crowd, either because of the management's track record, the size and richness of the asset, the presence of infrastructure, whatever it might be that makes that particular resource project stand out in the crowd. And when you've got 300 odd competitors, all trying to get funding, all trying to get noticed and compete for the investor's dollar, then you've got to stand out. You've got to have special things about you that make you stand out in the crowd. And the final thing is that you've got to buy well according to a repeatable plan. So it's getting that balance right between not guessing and buying too early and then getting stuck in something that goes down, but having a process where the probability that you've seen the lows and we're now starting on the next leg higher And it's not that hard. It's a pretty straightforward process. The hard part is the discipline and the confidence to stay with your conviction. So I think that's going to unfold as a seriously big opportunity in 2026. And it's so important to have a plan because this part of the market is more volatile. So this is not for the faint-hearted, and it's especially not for those that aren't prepared to nut out a plan in advance and understand what the journey looks like over the next 12 months. Because once you understand what the journey looks like, then the market doesn't really hold too many fears and surprises, does it? So for me, that's one of the big steps forward that investors should be taking. It's so much about risk management that allows you to feel comfortable, because if you feel comfortable, you are less likely to make panicked, not well thought out decisions when the market does something unexpected. So comfortable risk management is really, really important. Now, of course, we also advise that you get all the other kind of investment advice, financial advice, legal advice that is required before taking action on anything in this video. Now, before we go into the American indices, I just want to show you a couple of charts from last week. So we looked at LITE as an example of how the character of the trend had changed. So I compared this period through here, and this is where we sat last weekend. That was the Friday before the one just gone. So we looked at this period from the lows in April all the way through, and it was a pretty consistent pattern of advancement. But up in here, things have got really wild. You can see the candles much longer. We've got gaps all over the place. It's a totally different character here. So it was viable to ask, if the character has changed to this degree, then is this a more significant top? But let's take it forward day by day for the week that's just gone. And in America, that's only 3.5 sessions. So there was the first one. That's pretty emphatic on the Monday. There's the second one. That one's really a little bit more positive than you might think. Yes, it traded down a bit, but it did close near the session high. There's the Wednesday, and there's the Friday finish. So whilst we did get a change of character through here, that's just been completely erased. And if we look at NVIDIA, and this really gets to my point about the opportunity being away from the market leaders, the big mega cap stocks, because that is a stock that would be classed as small to mid cap in America. But let's look at NVIDIA. That is a completely different chart to that. So quite clearly, money is rotating from these mega cap stocks that have led the way for so much of the last couple of years into other areas of the market. And that's the real opportunity, because the percentage gains likely to be far, far bigger than what we've seen from the Mag 7 up to now. All right, looking at American stocks now. So the scoreboard says that the S&P 500 was up 3.7% for the week, and the Nasdaq almost made it to 5% higher. That's a big week, and particularly when you think that that was over 3.5 sessions, and it followed 2 weeks of very significant turmoil and fear and all sorts of emotions. That's a stunning week by the Nasdaq. The Russell also did even better, up 5.6. So money clearly rotating into the smaller areas of the US market. And it was pretty solid for small caps in Australia as well. So it's been a very abrupt shift back. So for me, the jury's not out anymore. The jury's come back. They've decided that this was just an over-leveraged, very short-term correction, and things are back to normal. So the odds now of a Santa Claus rally have improved quite dramatically. Nothing's ever a guarantee in the market, but they certainly have improved quite dramatically in the last week. But there's always a but and a however. It was a short week. A lot of traders in America would have taken a 4-day holiday. Liquidity was down. So maybe we shouldn't completely read that last week was a total positive. But certainly the close was very impressive. The US dollar index was down a bit from over 100 to 99.5. The 10-year yield eased back from around 4.1 back to almost 4. And the VIX, which had been up at 27 intra-week the previous week, has just collapsed back to 16.3. So any anxiety in the market seems to have moved on, that's for sure. So let's go and look at some of the charts there. And we'll start with the Nasdaq composite, because that's the growth stocks. So this is on a daily chart, and you can see I showed last week the prior 3 Fridays and how the bounce was just weakening a little bit. It just wasn't quite as emphatic. That was where we sat last Friday. This is the week just gone. So it would appear that all is forgiven when it comes to the more aggressive growth stocks of the market. So that's the Nasdaq composite. Semiconductors also did very well. And if we put this on a weekly chart, you can see that it was a very, very strong week indeed. So that's semiconductors. I'll go back to the last quarter. So this is a relative comparison chart from all of the US sectors, the main US sectors. So this is over the last quarter. We've got healthcare has certainly come from way down in the pack. Healthcare was right down towards the bottom, and it certainly reasserted itself. Technology, which had been a strong leader, came off a lot, but turned around quite a bit. And they're the only 2 sectors outperforming the S&P. Let's just move in a little bit to the last month. And you can see that in the last month, consumer staples and energy have done much better. And technology was very much at the bottom of the pack. And if we come into the last fortnight, then materials have certainly manifested themselves quite dramatically, and gold certainly played a part in. Healthcare still holding on, and that's been the beneficiary of the rotation. Communication services, banks and finance, consumer discretionary, they're all stacked up, and we've got technology and energy at the bottom over the last couple of weeks. In Australia, it's pretty clear cut in the last fortnight. Healthcare, similar to the States, has been a big beneficiary of the rotation. Then we've got small caps, followed by materials, and then information technology making a surge, and they all beat the ASX 200, with the banks and energy being the drag in the last couple of weeks. So there's the S&P on a weekly chart, so you can see we're very close to all-time highs, and it's bounced off this 20-week moving average quite nicely. And there's the Russell 2000, and I'll just put that on a weekly because it's very impressive on a weekly chart. There is nothing timid about that rebound that we've just seen last week. So that's where we sit with the American market. I'll just check the currencies while I'm here. So DXY came off the boil a little bit, was about 100.5 at the peak, and lost about 1 cent, and the Australian dollar had a bit of a jump up the last couple of sessions as the US dollar came off, but we're sort of stuck in this broad band that's been going on now for some time. All right, so that's the American stocks. The Aussie stocks, 64.88, and really there's a bit of a global risk-off trend. Our currency is never going to do terribly well in that sort of situation, and that's really what's just working off now. But if commodities really do get a head of steam up next year, you'll see the Australian dollar probably back over 70 cents again. Now, our index managed to gain 2.35% for the week, and whilst it was a short session on Friday in the US, I would imagine that the Australian market should open pretty brightly, although it certainly has been disappointing on many occasions, just has not lived up to the lead that the US market has given it. However, it was the first positive week in a month, so let's take it. The drag, as we saw from the chart before, was banks and energy. So banks finally getting the valuation reset that I've been talking about probably since this time last year, the banks had really confounded any kind of logical conclusion about valuation. So that adjustment is coming through now. There's really an interesting mix of broker upgrades and broker downgrades, and sometimes on the same stock. So it's a very uncertain, confusing picture as far as the brokers are concerned. Not that I pay any attention to broker upgrades or downgrades because you don't know what the assumptions are. But certainly there is quite a conflict of opinion there and some very wide ranges in the target prices. That makes it a market where what you own is really critical as we go through this rotation. And don't forget about small caps. I really think small caps could really be the opportunity of 2026, and particularly in the mining and minerals area. There's still alarmists around the place. They want to point to all sorts of historical facts and figures. They might be right one day, but it's certainly not yet. So the Australian market is progressing along reasonably well. All right, looking at the positioning for 2026, Insiders Club members have enjoyed a really, really good year because our processes have allowed them to proceed with quite confidence. That's the feedback that I get consistently. They're just feeling so much more in control of their investing. There have been many outstanding results within the US tech stocks, and especially with the local resource stocks as well. And the ones that we really narrow our focus to are the ones that do stand out in the crowd. So when it comes to the AI ecosystem, there is significant value has re-emerged, and that is such a broad church these days. There are so many stocks that are benefiting from AI, and it's not just the direct beneficiaries that you might think. This goes into all sorts of different directions. And there is some terrific value in terms of price earnings multiples relative to their growth rates. The big picture opportunity remains certainly in AI, so don't believe any of the narrative that you're seeing and hearing about the AI bubble bursting. It's just not correct. Many investors really just need to know the how-to. What is the process? How do you enter? How do you manage risk? How do you exit if you need to? So that's all covered within what we do within the Insiders Club. And then with resource development stocks, which is really our bread and butter, because we identify the real standouts and help you develop your own plan to make it work for you, because every investor is different in this respect. And it's just so important that you're operating to a plan that's going to be suitable for you. So with respect to the Insiders Club, the opportunity is really, it's a smorgasbord of services that we provide, really. There is your own plan to develop a portfolio that is far more likely to suit you than most investors develop on their own. And all the hard yards are done for you. So you could certainly do a lot worse than coming and joining us for a couple of months at least, and you will upskill yourself considerably, I promise you that. Contact us if you would like some more information. Turning now to precious metals. Gold had a big week, up $153 to 4217. So we're really nicely camped up above that 4,000 level. Translated to Australian dollars, 64.40. That's tremendously profitable, even though the all-in sustaining costs have surged for Australian miners. That's a very profitable area for Australian dollar gold price to be. But look, the big story was silver. It was up 13% for the week to 56.37, and the chart is incredibly impressive. And the futures on both gold and silver are pointing even higher. And that's on top of 7 straight months of gains for silver to new all-time highs. And the gold futures are also pointing higher, which is indicating that the trend is being supported to the upside. So we've got a situation where the central banks, and everyone knows that central banks have been far more prolific buyers in the last 5 years or so than they were prior to that. So central bank buying is providing this really nice floor price to gold that it keeps bouncing off. And then the big surge in retail demand is doing the rest. And if we look at the fund inflows for the week, $1.7 billion flowed into gold fund ETFs for the week. That's very impressive. If we look at gold stocks, the consolidation that looked like it was unfolding has run its course pretty quickly, and we've gone straight back into uptrend. So I would expect that we're going to see a pretty buoyant opening here on Monday, particularly silver stocks. So let's go and have a run through those. So we'll start first of all with the silver price. This is the silver price on a monthly basis because I wanted to capture the peaks back in 2011. So these were the all-time highs, just around $50 mark. Look at what's happened in the last 6 or 7 months. It's extraordinarily impressive, and it's perhaps even a tick faster than it was back here in 2010 and 2011. So that just shows you the speed with which silver has moved to the upside. And of course, at some point in time, there'll be a consolidation. And given the way that this is accelerated, that consolidation could be a bit severe. But this has got so much strength behind it that I think the uptrend is going to remain in force for some time. That's how I read this chart. Let's come in a dimension. We'll come into a weekly chart, and you can see just how impressive silver was on the week. And we only got really 2 weeks down. That was about all that's happened with silver. And if we put it on a daily chart, you can see that was incredibly impressive on Friday, given that it was a shortened week. This is gold in US dollars, nowhere near as spectacular as silver. Still a pretty solid week. And if we put that on a weekly chart, just to give you that perspective, it's still pretty good. This is still a high-level consolidation. This is a real show of strength when you see only 2 weeks down and then we abruptly turn around and start to head up again. In Australian dollars, that's where we sit. We're hugging the 8-week moving average. That's how strong this trend is. Let's just check on GDX and GDXJ. So this is the GDX Aussie listed index. Really good week, and we should see a continuation of that next week. And on the global scale, this is GDXJ, which, whilst it says junior gold miners, there's a heck of a lot of really quite large cap gold miners in this index. So that was a very impressive week for GDXJ. Right, turning to other commodities now, copper also had a very good week, up to $5.19. UBS are forecasting $5.80 by the end of 2026. There is currently good signs of strong support in the market. There's some supply premiums being achieved to Chinese buyers. The December rate cut expectations are helping because that's sort of putting a bit of downward pressure on the US dollar. Producer valuations in copper are really quite stretched in my view. If you look at stocks like Sandfire, they're hardly a bargain. But there's certainly some outstanding opportunities with the smaller developers, particularly the ones that really stand out in the crowd. So I think that is the sweet spot in copper. And given that copper is going to be in a deficit for perhaps a very, very long period of time, I think this is really one of the best opportunities that you'll see in the next couple of years. So for me, the developers that are progressively de-risking their project and that can stand out in the crowd and that have got good management, if you can get all that in a package, then you've got a high probability investment. Crude oil jumped up a little bit, 59.5. It's consolidating the big decline we had last week. There is a large oversupply expected in 2026. There is a bit of a downside bias if Russian exports return to the market, and if OPEC makes a decision that releases more oil into the market, then for me, the probabilities for oil are to the downside. Here's the spot copper chart, back up almost to the 520 mark, and there's the crude oil chart, and it's definitely in downtrend at the moment. So wrapping it all up, the key is risk management, as always. I think you should be not getting too besotted with what happened last week, but trim the expensive stocks. Trim the really crowded trades, the ones that are on social media, the meme stocks. Certainly trim them back pretty hard. Stocks with great balance sheets should be more the focus rather than the really high risk, high valuation stocks. Use the dips for rotations and be very selective in your choice. I think it's okay to be close to fully invested at the moment. Last week was so strong, so emphatic, that I don't see any reason to be holding significant levels of cash. It's more about making sure that you're in the right sectors, you're in the right stocks with good quality balance sheets and getting good entries. Portfolio last week, we had a real focus on copper, so that's worked out very nicely given the surge in copper price late in the week. We looked at how to play this very uncertain market, or what was an uncertain market a few days ago. Certainly it's clarified a lot in the last couple of sessions. And we were also identifying great reversals in quality stocks as well. So that's it for this week. There's more information on the website. There's my email address for anyone that wants to make contact. And I'll be back with you next Sunday. Cheers.